Well, my next guest says traders may use this holiday shortened week in the U.S. to try and push the euro firmly above that sticky 150 level against the dollar. Todd Gordon is a currency strategist with Gain Capital. Joins me here in studio. Todd, thanks for joining us. And we've got the euro right around the 150 level against the dollar right now. But this, throughout the year, has... I mean, is it fair to call it a sticky level?
It certainly is, and it seems to echo a 2006 move. Traders who remember sitting down at Thanksgiving dinner when we were around a sticky 130 level. As soon as we got up from Thanksgiving dinner, we saw euro 200 points higher. So I think that's kind of sticking in our minds for potential illiquid push once North America is sitting down to dinner.
So there's less trading activity, and then somebody can say, you know, it's time to just make a move, buy euro, sell dollar, and you could see a move above that level. Is that something that could be sustainable, though? I mean, you know, we talk about levels like whatever you want to talk about, 10,000 for the Dow.
Yeah, I believe it's the path of least resistance in the near term, heading through the holiday into next week, into the thin Christmas holiday season, I believe, is up. But I think we're looking at some significant levels in the other currency markets. If you notice, if you look at the intermarket relationships between euro and Aussie, okay, Australia was one of the first banks in the G8 to start raising interest rates. All of a sudden, you're noticing Aussie coming off the highs, whereas euro's still at the highs. I believe it's more of a euro gold situation. Right. And it seems to be Aussie is signaling to the rest of us that risk aversion may not be as low as everyone thinks it is.
We were just showing a chart of the dollar index, tracking the dollar against a basket of currencies. Everybody's talking about this relationship between stocks and the dollar. Is it as strong right now as it has been for the full year, or is that starting to change?
The trend is certainly there, but we can't mistake trend for volatility. Okay, the trend of the dollar is lower, equities higher, but if you're going to notice, look at an indicator called the average true range, okay? So we're just going to measure the high to low on a given trading day, average it out over a couple of sessions. It's very low. It's the ranges we're seeing, which is synonymous with volatility, are at such low points, just the same levels seen just prior to 2008 break, ups in euro, break down or break up in equities down in euro. So I would expect volatility come back once this holiday season comes to close.
I can't let you go before we talk briefly about the gold story, because gold just continues to climb. It almost feels like there's a lot more than just the currency market influencing gold right now.
Yeah, it seems like, I mean, gold is the pure commodity play that is breaking through new highs. You're not getting confirmation from these other metals markets, precious and industrial, especially industrial metals, which echoes that Australian dollar story. So again, it just seems to be a euro and a gold story in an illiquid, low volatility market, which I think risk aversion would be back on the high. And if the Dow and the S&P come off some of these levels, 10.3, 10.4 in the Dow, 11.20, 11.30 in the S&P, then I think you're going to see a return to that risk aversion.
All right, Todd, thanks for the insight. Dollar, gold, stocks, appreciate it.